Okay, let's unpack this. Have you ever found yourself wondering why, despite all the data, all the logic, people sometimes make financial choices that just don't seem, well, rational?
Hmm.
It's a question that pops up, when you see the market swing wildly, or maybe even when you reflect on your own investing habits.
Absolutely.
Today, we're diving deep into your sources on behavioral finance. It's a field that offers some, frankly, pretty compelling answers.
It really does.
So, our mission for this deep dive is to sort of pull back the curtain on how human psychology, those universal quirks and tendencies that make us human, how that profoundly impacts our financial world.
Yeah, it's huge.
We'll explore why financial decisions aren't always made with, like, perfect spreadsheet precision. And really importantly, what understanding these underlying human dynamics means for you as you navigate markets or manage investments.
Right. Or even just trying to make sense of the headlines.
Exactly. Think of it as a shortcut to being well-informed, maybe with a few surprising facts thrown in.
Mm. And it's vital because, traditional financial theories, they often build their whole framework assuming perfect rationality.
Right, the economic man.
Exactly. Investors, as purely logical actors,
Yeah.
always maximizing utility based on all information. But behavioral finance steps in and says, hold on a minute.
Yeah, not so fast.
It gives us a much more human and honestly often a more accurate picture of how decisions actually unfold in the real world. It acknowledges emotions, biases, social influences,
All the messy stuff.
all the messy stuff, which leads to outcomes that can be, well, pretty unpredictable from a purely logical view. It really bridges that gap between economic theory and, human reality.
That's a crucial distinction. So to kick us off properly, for our listener who tracks markets, understands the headlines, what is behavioral finance at its core? How does it really challenge or maybe enrich those traditional models?
Well, at its core, behavioral finance tries to explain how decision makers actually make financial decisions, not just how they should, according to
Okay.
theory. It really digs into the why behind choices that might look, well, irrational on the surface.
Yeah.
And these choices can have unexpected, sometimes pretty profound consequences in the markets.
So it's not just a contrast, it's more like an evolution of thinking.
I think that's a great way to put it, yeah. It moves beyond that idea of the perfectly rational actor to acknowledge our real psychological makeup. For someone already engaged with finance, it offers a much more nuanced lens to view things like market efficiency, risk, even how assets get priced.
And as we dig into your sources, what really stands out are these specific patterns of human behavior. Let's shine a light on those because they're probably things you, the listener, have observed, maybe even in yourself, right?
Oh, definitely.
Without maybe fully realizing their financial impact. These aren't just abstract ideas. They're kind of the invisible forces shaping market reality. So first up, let's tackle a really mind-bending idea, a paradox right at the heart of what we think makes markets efficient. It's called the market paradox.
Yeah, this one is fascinating because what's really interesting here is how belief itself doesn't just reflect market reality. It actually actively shapes it.
Shapes it. How so?
Well, the market paradox basically says that for markets to be truly efficient, prices instantly reflecting all available information, investors have to fundamentally believe the markets are actually somewhat inefficient.
Hang on, that sounds backwards. Why believe they're inefficient if you want efficiency?
Think about it, right? If every single investor believed markets were perfectly efficient, that all prices were always correct and couldn't be beaten, well, what would be the point of doing research?
Ah, okay. No point in analyzing companies or trying to find undervalued stocks.
Exactly. Why try to find an edge if you believe no edge exists? So if nobody was actively trading based on new information they thought gave them an advantage.
And the market wouldn't react efficiently to
Right.
that new information. It's
Yeah.
circular.
Precisely. The very act of people constantly searching for an edge, driven by that belief in some inefficiency, is what actually helps push prices towards their true efficient value.
Wow.
If everyone just passively accepted prices, believing in perfect efficiency, the market would quickly become less efficient because new info wouldn't get factored in quickly. It's that constant hunt for opportunity that drives the system.
That really does challenge basic assumptions, doesn't it? How our perceptions literally help create the market's reality.
It does. It turns conventional wisdom on its head a bit.
So if our belief in inefficiency kind of creates efficiency, that implies this constant tension. How do we, as investors, navigate that? Do we need to believe the market is inefficient to participate well?
That's a good question. You don't necessarily need to actively believe it's inefficient, I don't think.
Oh.
But understanding this dynamic exists, that helps you appreciate the market's constant churn and why prices move. It helps explain why active management persists, even when passive investing often does well. It's that human drive to seek advantage that fuels the whole information processing machine.
So for you listening, it means recognizing that while finding a true edge is hard, the pursuit of it is actually fundamental to how markets work.
Right. It's part of the engine.
Okay, shifting gears a bit. Let's move from that sort of philosophical market-wide thing and zoom in on something maybe more relatable day to day. We've all seen it, right?
Yeah.
That collective euphoria or panic in the market.
Oh, definitely.
That rapid surge or plunge in a sector sometimes seems totally divorced from the fundamentals. That's often a classic example of herding, isn't it?
Absolutely. Herding in finance is exactly what it sounds like. It's when investors buy or sell shares, basically because lots of other investors are doing it, not necessarily based on their own independent analysis.
And why do people do that? Is it just fear of missing out?
That can be part of it, for sure. But it's driven by some powerful psychology. Sometimes it's just social conformity, not wanting to stick out from the crowd.
Safety in numbers.
Exactly. Or sometimes investors just lack the confidence in their own judgment, so they figure, well, this large group of people can't all be wrong, right?
And the practical impact of this, well, it can be massive. We've seen it play a role in everything from the dot-com bubble to, more recent meme stock situations.
Precisely. If loads of investors follow this herd instinct, they all rush into maybe one particular sector, and that can cause huge, rapid price rises, sometimes totally detached from any real improvement in the companies themselves.
And that's how bubbles form.
It's a major contributor, yes. In extreme cases, this collective momentum can absolutely inflate a stock market bubble. Prices get wildly out of sync with value.
So the danger for you, the listener, isn't just getting swept up in it.
Right, but also recognizing when the herd might be taking a detour from rational valuation. And it works on the downside too, of course. Collective panic can lead to rapid selling, pushing prices way below intrinsic worth.
So for our listener, recognizing when sentiment is kind of driving the bus more than fundamentals seems key. How do you spot that? How does behavioral finance suggest you identify herding and maybe not get caught up in it, or maybe even respond strategically?
Identifying it often comes down to vigilance, really. Are prices moving way faster than the actual company news or sector performance would seem to justify?
Okay.
Is the story more about everyone's buying this rather than, this company just reported great earnings?
Right. The narrative shifts.
Exactly. Strategically, it really comes back to disciplined, independent research.
Yeah.
If your analysis doesn't back up the frenzy, resisting that urge to jump in is crucial. It's hard,
Yeah.
but important.
Easier said than done sometimes.
Oh, absolutely. Sometimes, if you're genuinely contrarian and confident in your analysis, it might even present opportunities to go against the herd, but that takes real conviction.
Okay. Now, this next insight from the sources. This might make you question assumptions about even the market professionals, the folks who do this for a living. It introduces us to noise traders.
Ah, noise traders, yes. They're a fascinating and often disruptive element in the market. These are traders who, and this is the key part, don't base their decisions on fundamental, rigorous analysis.
So not looking at balance sheets or future prospects.
Not really, no. Instead, their decisions are often swayed by fleeting sentiment, maybe rumors they heard, gut feelings, or just trying to follow a trend they perceive without really understanding what's driving it.
They're trading on the noise rather than the signal, basically.
That's a perfect way to put it, yes.
And what are the sort of telltale characteristics of these traders? How do they behave?
Well, characteristics often linked to noise traders include making poorly timed decisions, buying high just because a stock is rising fast, and then panic selling low when it falls.
Chasing momentum, maybe?
Yes. They tend to amplify trends rather than identify underlying value. Now, their individual actions might seem irrational, but collectively. Noise traders can significantly add to market volatility. They can even cause short-term mispricings.
So they actually move the market.
They can, in the short term. What's interesting, though, is that their very presence, while making markets maybe more unpredictable, can also create opportunities for more fundamentally driven investors.
How so?
Well, for those investors who are doing the deep analysis and can spot these temporary deviations from true value caused by noise trading.
Okay, so what does this all mean for us? It suggests that even the pros, or at least a chunk of them, aren't immune to less than rational behavior, and their actions can definitely ripple through the market, impacting even the most informed investor.
Absolutely. The existence of noise traders is a stark reminder that markets aren't just these cold, logical machines. They're bustling ecosystems full of diverse participants, and not all of them are playing by the same rational rulebook.
Right.
So for you, it really underscores the importance of sticking to your own well-researched investment plan rather than getting, whipsawed by every market swing or speculative rumor you hear.
Okay, that makes sense. Let's talk about a really deep-seated human tendency now. One that's incredibly powerful, often overrides logic, our profound dislike for losing. This brings us to loss aversion.
Ah, yes, loss aversion. This is a truly potent psychological bias, and it's more insidious than just avoiding a bad investment generally.
How do you mean insidious?
Well, it describes how investors actively avoid investments that carry any risk of making losses, even when, say, an expected value analysis strongly suggests that over the long term, these investments are actually likely to produce significant gains.
Because the pain of losing feels worse than the pleasure of winning.
Exactly. Psychologically, the pain of a loss is often felt about twice as strongly as the pleasure of an equivalent gain. It looms much larger in our minds.
So it's not just general risk aversion. It's specifically hating to realize a loss, even if selling is the logical financial move. Can you give us a concrete example of how that plays out?
Sure. A classic example is holding on to a losing stock for way too long. You keep hoping it'll just get back to break even.
Right, just get my money back.
Exactly. Instead of selling it, accepting the loss, and reinvesting that capital into something with genuinely better prospects, you just don't want to lock in that loss to admit defeat.
And the flip side.
The flip side is selling a winning stock far too early, just to lock in a gain, even a small one, because you're afraid it might reverse.
So you cut your winners short.
Precisely. You miss out on potentially much larger growth because the fear of the gain turning into a loss overrides the potential for further upside. This bias can profoundly distort how we manage our entire portfolio, often without us even realizing it's happening.
Wow. Yeah, it really raises that question about how our sort of primal fear of loss can just stump all over logical calculations about long-term gain.
It really can.
That's a perfect example showing the tangible impact on actual returns. So for our listener, recognizing this bias is step one. What's a practical way to fight it in your own investing?
Well, one of the most effective strategies is to try and take the emotion out by setting clear rules or targets beforehand.
Right.
Like, for example, using stop-loss orders. Set it up so it automatically sells if a stock drops by a certain percentage. That removes the agonizing decision from the moment of loss.
Takes the emotion out.
Right. Or conversely, maybe set clear profit targets that encourage you to let winners run to a sensible point before you take profits, rather than grabbing them too quickly. Diversification also helps, of course, because then no single loss feels quite so catastrophic.
So try to externalize the decision as much as possible.
That's the key. Take the immediate emotion out of the equation.
Okay. Finally, let's look at how sentiment can kind of build on itself in the market, creating a sort of self-fulfilling prophecy that can last for a while. This is the momentum effect.
Right, the momentum effect.
Yeah.
This describes a scenario where a period of rising share prices starts to generate a general feeling of optimism in the market. It's almost like a positive feedback loop.
All right.
And this optimism then fuels an increased willingness to invest, especially in companies showing growth, because the expectation builds that prices will just keep going up.
So it's the belief that what's going up will keep going up.
Essentially, yes. Or, on the flip side, what's going down will keep going down. It's not necessarily driven by sudden changes in fundamental value, but more by the psychological power of a sustained trend. It creates a kind of inertia.
So this effect, if it exists, and the sources suggest it does,
Oh yeah, there's strong evidence for momentum across different markets and time frames.
then it's likely to make booms last longer and busts go deeper.
That's the implication, yes. Positive sentiment can keep a bull market running perhaps longer than fundamentals alone would justify. And negative sentiment can definitely prolong bear markets, creating those really deep troughs.
So for an informed investor, understanding momentum is pretty crucial then.
It is, because it helps explain why markets can often overshoot or undershoot their fundamental value for extended periods. It makes purely value-based investing quite challenging sometimes, especially in the short to medium term. It really highlights the power of that self-reinforcing human psychology in market cycles.
Okay, so we've unpacked these individual pieces. The market paradox, herding, noise traders, loss aversion, the momentum effect. We've seen how each one highlights a different aspect of how we actually make decisions. So when we pull all these threads together, what does this tell us about the market overall? And maybe more importantly, how does this collective picture empower you, our listener, as you navigate your own financial world?
Well, when you synthesize these concepts, I think the core message becomes really clear. Behavioral finance shows us that individuals, whether acting alone or, as part of a crowd, may not necessarily make decisions based on a purely rational analysis of all the information.
It's not a criticism, it's just reality.
Exactly. It's simply how we're wired as humans. And this reality can lead to significant deviations from what might be considered a fair price for individual stocks.
Right.
And it can also cause the market as a whole to go through these extended periods where prices are collectively either very high or very low, rather than always sitting perfectly at some fundamentally justified value.
So it's really about recognizing that markets are inherently human systems, not just mechanistic calculators. And knowing that gives us an edge, doesn't it? Or at least a better understanding.
A much better understanding, absolutely.
Yeah.
It's important to realize you don't need an academic mastery of every single tiny cognitive bias to be effective.
That's reassuring.
It is. But understanding these fundamental concepts we've touched on today, herding, loss aversion, momentum, noise, that is a truly powerful analytical tool.
How so?
It gives you a lens to see past just the numbers and understand the human element driving things. It helps you distinguish between, say, a real fundamental shift and just a psychological swing.
So you can maybe anticipate or at least make sense of why markets sometimes do seemingly irrational things.
Precisely. It transforms you from just being an observer of prices to becoming an interpreter of market psychology.
We've explored how deeply human psychology really does influence financial markets. It reveals them as far more nuanced, much less purely logical than maybe traditional theories led us to believe. So for you, understanding concepts like herding or loss aversion isn't just academic trivia. It's a vital step in becoming a more informed observer and, frankly, a more thoughtful participant in the financial world. It helps you recognize when maybe emotion, rather than pure data, might be driving things, and critically, how you might want to adjust your own thinking or strategies because of that.
And that leads, I think, to a final provocative thought for you to take away. Given how deeply our own psychology, our collective human behavior, can shape something as seemingly objective as financial markets,
Yeah.
how might these same powerful principles, these same biases and tendencies, influence your own everyday decision-making? Not just financial, but, anything else. How often do you make choices based on a gut feeling or following a trend or avoiding a potential small loss rather than purely on dispassionate logic?
That is a fantastic question to ponder and one that definitely extends far beyond the trading floor. That's all for this deep dive into the fascinating world of behavioral finance. We really hope you've gained some valuable insights, maybe a new lens to view your financial world through.
Hope so.
Until next time.